told us the generational buying opportunity was upon us. Joining us, Mr. Miller's back. He's the Chief Investment Officer and Portfolio Manager at Miller Value Funds. So, Bill, credit to you. Number one, the timing and the aging of that last comment here on our program looks pretty good. How much is left in the tank here?
A lot less. I mean, we've had a lot of, the market's done well overall, but we've got many names in the market, you guys have mentioned them, that are up, not what the market is, from the lows, but up 50% or 100%. So that burns off a lot of potential returns. And I think that the best values in the market now are in the smaller cap names, the mid cap names, things that have tended to lag the overall market. And there's a lot of them out there. So I think up here at, where are we, at 29.50 or so in the overall market, I would guess that, I wouldn't be surprised to see a pause here and take us down 5 to 7%. I would be surprised if we fell more than 10%, given the liquidity that's being pumped in there by the Fed and the amount of cash on the sidelines.
Bill, when you talk about small caps and some of the other areas that have not had those monster bounces since the bottom, do you believe what this market is kind of trying to hint at? The last week seems like last Thursday, the intraday turnaround led by banks. I haven't seen something like that in quite some time. Is that turning point upon us?
Yes, I think so. Today's an interesting day because you've got the Russell up, 40 basis points and the S&P down 60, so 100 basis points swing between those two. And I think that you mentioned the banks. The banks are the cheapest they've been relative to the market, really in history, and which is remarkable given that they're cheaper now relative to the market than they were at the bottom in '08 and in '09 when many of those companies were, in very desperate financial condition. Now the banking system and the big banks are as strong as they've ever been. So I think it's an obsession with the length or the level of interest rates and the flatness of the curve and the compression of net interest margins. And I think that the next move in that is going to be higher in the curve. The Fed's going to keep short rates pinned, but as the economy reopens and gradually gets stronger, that curve should shift upward, and then people are going to really want the banks. So I think today, you mentioned today, I think some of this beleaguered groups, banks, retailers, those sorts of things are sort of a sign of what's to come, but it won't be a straight line.
Bill, what could get in the way of it? Is it a fiscal bridge that comes up short based on an extended closing or any return of the virus or any surprises on that front? What's the big risk here that you see?
I do think there's a political risk, and when the market was collapsing, the various parties got together and along with the Fed and moved very fast, to get the CARES Act passed, and now there's a lot more squabbling. The House, passed a $3 trillion bill that has no chance in the Senate, and there's a lot of finger pointing and blame about what we're going to do with the states and what we're going to do with with extending benefits. So I do think there's a risk there. I think that as long as the market is not reacting too terribly negatively to that, I think we don't have to worry about that. A second wave of the virus that led to a second set of lockdowns would be a big problem, because it would indicate that there is no coherent policy to deal with pandemics on a recurring basis, or even just the return of the virus. If we're going to take another several $1 trillion whack to the economy and keep businesses closed just because we've got a group of people that get sick who didn't get sick before, that will be very bad for the market. I don't expect that, but I think it is a risk.
Not to go too much into kind of the virology conversation here, Bill, but do you think that we need to have some medical breakthrough treatment or vaccine-wise to see strength in this particular reflationary trade? Because that's what did it last week, the news that there was progress being made, and then the follow-through this week too. Do we need that to have a big pop in all of these going out and reflationary stocks, or can just a gradual reopening at the pace we've already seen be enough?
I think a gradual reopening, the market's, again, not going to move linearly and in a straight line, but as long as the economy is opening and people are going back to work, and we'll hit the peak in unemployment and in claims, and that starts to roll over, that, again, given the amount of liquidity that's out there and the amount of money the Fed's putting into the economy, that'll be enough to underpin the overall market. I do think that any progress on a vaccine or treatment protocols that significantly reduce the death rate and the recovery rate would be great for the market. But again, a fair amount of that progress is priced in off that 21.91 low.
I want to talk a little bit about where you still see value and to kind of define this cyclical group we discussed last time a little bit more. I rewatched our interview and it seemed like you were curious in looking at some of the beaten up areas like cruise lines and airlines, but weren't necessarily pulling the trigger at that time on March 26. What about now after they've continued to dip and some of these move sideways? Are they more interesting now?
I think they're moderately more interesting now. It's on a case-by-case basis. We own the airlines. We owned them going into this,
okay.
And we still own them. I think that they've been strong in the last week or so, but I think they just got oversold. There was, of course, a reaction when Warren Buffett sold out all of his airlines. But so we think that there's potential there. That's probably the riskiest part of our portfolio. Is the airlines. But you had Jeffrey on earlier. I agree with him. I think the home builders are about as easy as it gets if you look out over the next 12 months because rates are going to stay low for a long time and inventories are very low. And now the one thing that was holding back the home builders was unemployment was so low they couldn't get workers. So now I don't think that's going to be an issue. So I think we're seeing already in the home builders stock price action some optimism, but still stuff like Taylor Morrison still trades well below book value, and about its stock is 17. We think they'll earn $4 in a year and a half or so. So it ought to be a $40 stock.
Bill, what role will bonds play in this scenario? Let's say we keep reopening at this pace. Let's say this kind of recovery and reflationary trade takes hold. Do bonds get in the way of high valuation stocks if they sell off hard like they did in September and cause problems, or do bond flows reverse and just provide a support to equities if investors say, you know what, I don't need the treasuries anymore?
It's very tricky with bonds because what they've done is that's where people hide when they don't like equities, and the fact that you get a negative rate of return in bonds, after tax and after inflation, is not a deterrent, or hasn't been so far. I do think that as things get better and then bonds start to sell off, I mean, if you've got the 10-year at 60, 70 basis points and it goes just back to 150, that's a pretty good whack on your principal. I don't think that kind of a move, which would be, as I said, a pretty good hit to a bondholder, would have any impact at all on equities because it would coincide with a much strengthened economy, and the Fed is going to keep the short rate pinned until inflation is, call it 3 to 4%, and we're years away from that. So I think you could easily see, a case where the market over the next, let's say, year and a half goes to all-time highs, but bonds sell off fairly sharply.
Bill, one other thing I just want to get your thoughts on. I usually don't ask investors about other investors, but I can't resist because some really big names have been taking the other side of the bullish trade. David Tepper has said it's the second most overvalued market he's ever seen. Paul Tudor Jones is buying Bitcoin. What do you feel when you see some of these other long-term investors be sounding such alarm bells?
Hey, I mean, those guys are great. Stan Druckenmiller is as well. So, whenever you have people like that expressing strongly held views about the market and they're contrary to, I'd say, my view right in here, although I agree that David, that 1999 was the most expensive market that I've seen. I just don't think that this particular market is terribly expensive unless your time horizon is extremely short. If you look at, like the way Stan invests, I mean, Stan can turn on a dime. He could be bearish, last week and be bullish in 2 weeks. So, but he does give you, I think a good sense of where he currently sees things. My personal view is that as long as the economy is improving from whatever low level you have, and as long as the Fed is accommodative and bonds and inflation are not a problem, and there's plenty of values in the marketplace. I mean, Teva Pharmaceutical is the largest generic drug company in the world. 1 out of every 8 prescriptions in the United States is written by Teva. And even though Teva's up so far this year, 20%, it still trades at 4.8 times earnings with a 15% free cash flow yield. So it's a tremendous bargain. And, in my opinion, I think there are bargains out there. I'd rather look at individual stocks as instead of I don't really need to be in everything.